There's been good and bad news for landlords in the government's latest 2024 spring budget, and in this video we're going to be going through the 4 tax changes which will affect us as property investors. Kicking off with the first tax change is furnished holiday let tax regime has completely been abolished. This is basically where you had tax benefits if you were investing in furnished holiday lets. That comes under capital allowances, mortgage interest relief, the way that you contribute towards your pension, and also joint ownership and how you can split the profits, which has completely been abolished. But the one thing I want to focus on today is the mortgage interest. This now means that if you own a furnished holiday let or an Airbnb in your own name, which has a mortgage, you are no longer allowed to deduct the mortgage interest as an expense. So why is this important? Why is it that you can no longer deduct your mortgage interest and you end up paying more tax? Well, I've got a very basic example. I'm going to emphasize the word basic here. So what I'm going to show you here is how this mortgage interest section 24 now works. If you're buying or owning property in your own name and you are a 40% taxpayer, because it will only affect higher rate taxpayers. Here's why. So let's say our rental income, we'll just split this actually, we'll split this to keep this separate. Let's say our rent is £1,000 a month. Our mortgage interest is £500 a month for easy figures, which leaves us with a pre-tax profit of £500. Because we've got our rent at 1,000 minus an expense, which is 500, leaving us with a pre-tax of 500. You would now expect, this is how it used to work in your own name, that you could obviously just pay tax 40% on £500. So our tax at 40% of 500 is 200, which means our net figure is going to be £300 a month, as an example. Section 24 came along. They now stop you from deducting your mortgage interest as an expense, which means you are taxed on this amount, the top amount, not that. Probably guess, you can see already what's going to happen here. So if we take 40% tax of 1,000, this means our tax to pay is now £400, but the government are nice and they've given us a 20% mortgage interest tax relief. Sorry for all this terminology, but this is kind of what you need to understand if you're going to get into property investment. So that means that a 20% of 500 is £100. So we take that off the top figure, which means our tax to pay is going to be £300. It's £100 more because of this rule that's come in. And remember, our pre-tax profit is still 500 because that hasn't changed. So now we do 300, which is our tax to pay, minus our pre-tax profit, which means now we're only left with £200 a month because of this small change. Now, £100 might not sound like a big difference. If you've got multiple properties, that could be a big problem. And I would even go one step further and show you why limited companies might be the better option for you now, is because your mortgage interest you can deduct. It's an allowable expense, so it's completely different. Section 24 does not apply in limited companies, which is great news for property investors. This means that we are taxed on this amount, the £500, because we still have £1,000 coming in, minus our mortgage, which we can deduct, which leaves us with a pre-tax profit of £500, but corporation tax is 19% up to £50,000 of profits. So 19% of the £500 means that our tax is going to be £95, which means our net figure, our take home, is going to be £405, which is obviously more than double than what it would be in your own name with Section 24 in place, which is why a lot of investors now are going towards limited companies. Yes, there are other taxes involved in limited companies, such as dividend tax, which is currently 8.75%. for the basic rate at the time of recording. So you would have to pay that if you wanted to distribute dividends, which is from your profits. But if you wanted to reinvest that into your limited company, you can see that it's more than double the amount and it would be the best option. So this tax change is coming in April 2025. It's already in place in full on the buy-to-let sector. Now it's filtering through into furnished holiday lets. In my opinion, it's very unfair, as you can see from that example, that you will end up paying more tax because they're stopping you from deducting one of your biggest expenses, which is your mortgage. And one more thing I want to make aware about furnished holiday lets, they didn't mention this in the spring budget, but it is looking likely that it's going to come into place. They are making a new change of use planning permission for this. What I mean by that is currently we have C3, so when you apply for planning permission, a C3 change of use is known as a family dwelling or a single dwelling. So this is your typical residential home. You then have to apply in Article 4 areas or in general for planning permission. C4 change of use is HMOs, so house in multiple occupations, such as student house shares and working professionals. So typically, if you buy a C3, you have to get what's called change of use to C4 to change it into a HMO, and a lot of tick boxes that you have to go through to get that approved. And now they are bringing in C5, which is short-term lets / furnished holiday lets / Airbnb, and that is going to become its own use class, which means you'd have to apply. Obviously, if you bought a family home, you would have to apply for this. That will bring in its own obstacles, again, with more checkboxes and criteria that you have to meet. Probably like fire regulations as well will be involved, which is good because it's all about the guest safety. People may not like this change. I welcome it because what we saw in the HMO industry is that as they stopped allowing more people to do HMOs, it created actually less supply of HMOs, but the demand for better quality HMOs actually went up, at least what I've seen, because obviously there's no more HMOs allowed, so the ones that are existing already are obviously coming up to a better standard to attract those tenants to come in and obviously live there. So that's a big change that is potentially going to be happening in the furnished holiday let sector by bringing in this new use class C5. Moving on to the second tax change, they are abolishing what's known as multiple dwellings relief, and this will affect the big hitters out there, those who are buying more than one property or a block of flats in a single transaction, where multiple dwellings relief used to be able to get you a stamp duty discount across that purchase if it was in one transaction. This has been abolished from June 2024 and you will no longer get that stamp duty relief. But now let's move on to a little bit of good news, because it's all a bit doom and gloom at the minute for landlords, but there is some good news with tax change number 3, which is capital gains tax. Now, first of all, what is capital gains tax? Well, it's a tax that you pay when you sell a property in your own name. If it's your own home, your principal primary residence, you may be eligible to not pay tax at all because you will get private residence relief on that, so you don't need to pay capital gains tax if it's your own home. However, if you have a second home or an investment property in your personal name, you will have to pay capital gains tax. Currently, there are different thresholds for capital gains tax. You have, and it depends on the salary. So if you're a basic rate taxpayer, which is up to £50,270, if you earn below that amount, you're a basic rate taxpayer, and the capital gains tax is currently 18%. If you earn above that amount, you are a 40% or a 45% additional rate taxpayer, and the capital gains tax for that is 28%, but the government are reducing this now, just this one, to 24%. Why are they doing that? Well, in their policy objective, they have stated that they're hoping that this 4% reduction in the tax will incentivize landlords who own multiple investment properties or second homes to sell, which will hopefully encourage market activity, more property transactions, and allow home movers and first-time buyers to get onto the property ladder. Personally, I'm not so convinced that this small 4% tax change will do that, but they obviously think there's an incentive behind this. And one thing to note is that this tax change will come into play in April 2024. And the final and fourth tax change related to property investors in the spring budget, which again is a little bit of positive news, is VAT. What is VAT? It's a value-added tax, currently at 20%, added to products and services sold by VAT-registered businesses. Now, currently, the VAT threshold is £85,000. So if you have a business which turns over £85,000, you have to become VAT registered and add that 20% markup to your products or services. The government have now increased this to £90,000. Again, I think is a little bit pointless because it's such a small difference, but positive news nonetheless for property investors who are running an Airbnb business, because there is VAT applicable on Airbnb. You are VAT exempt if you're running residential property such as buy-to-let rental income, and HMO rental income is exempt from VAT, so you won't need to worry about this. But if you are a property trader, such as a deal sourcing company, or an estate agency, letting agency, if you have an Airbnb business, for example, these are all trading businesses and you will need to register for VAT. It does allow that little bit of flexibility if you're hovering around the £70,000, £80,000 mark. Obviously you're thinking, oh, now I need to go VAT registered. You've now got a little bit more leeway up to the £90,000. Now I have read the policy objective from the government behind this tax change. And the tax reduction, they've said, is supposed to support small businesses by cutting their taxes and helping them grow. So this comes into effect in April 2024, where you will now become VAT registered when you hit the £90,000 mark, which is a £5,000 increase. And whilst there might be some benefits of becoming VAT registered, for example, you can reclaim the VAT that you're expending on purchases, which is great news. Alternatively, flip side, the negative side of becoming VAT registered is you do obviously have to increase your markup by 20%, because obviously that belongs now to the government. You're collecting that VAT and giving it to them. And second of all, is that your accountancy costs will likely increase, because it's usually quarterly VAT returns every quarter, which means that there's a little bit more bookkeeping to do, and obviously that becomes an expense for your accountant to, consistently do those VAT returns for you. So there's the pros and cons of becoming VAT registered. So there we go, guys. There were my 4 tax changes that I believe will affect landlords the most from this spring budget. Just to summarise, don't get too disheartened or fixed on these changes. It's just another stepping stone that we need to get across. And that's the most important thing about investing in property, is to be adaptable and flexible to these changes, whatever thrown at us. The truth is, you will always make money in property if you do it correctly, if you get the right education and the experience, and you'll make money, because that's the whole point of running a property investment business. Plus, you'll be providing, hopefully, what I encourage, high-spec accommodation for your tenants and guests. If you do like this video, please do like it. Leave it with a comment down below. I'm still getting used to this YouTube stuff. And, of course, subscribe to the channel. It doesn't go unnoticed. Your support is incredible. Please do continue to support by subscribing, and I will see you guys in the next one.